Get what I'm trying to say. Okay, so today we're doing chapter 2. I am going to go ahead and share from the You Can Pass website. I know you guys have seen it. What has been kind of like the toughest thing for like any particular concept that is hard, or like the whole thing is confusing? Or is it just too much concepts on it?
I guess too much in one chapter. Yeah.
Okay.
It's too much at once. For me, it's the wording. It's always the wording.
The wording of it? Okay, so let's try it and see if we can change the wording a bit on it. So chapter 2 is basically all type of life insurance policies, and they're going to basically tell you the same thing a few different times, but if you understand the same concepts or the same key points, you'll be able to differentiate them when it comes to it. So let's go through the terms to know. So it's a few of them in here. So for attained age, it ensures age at the time of the policy. So if I'm applying right now, my attained age is 35. If my birthday is next week, and that's when they approve the policy will still be calculated at age 35. So when it's issued or renewed, basically. So if the policy is 30, it's actually an easier way. If it's for 35 years, I will always be paying as when I got the policy at age 35. You know, it's not going to be changing when I'm 40, when I'm 50, when I'm 60. Like it's always at that attained age. The cash value of it is the savings account that some policies come with, like the whole life policies come with. So cash value, it's exactly that. It's cash value, cash that you can take out of an account. Okay. Face amount is the amount of benefits stated in the life insurance policy. In chapter 1, it was also called the death benefit. So face amount and death benefit are basically the same thing. Is the amount of the benefit stated. So death benefit, as we saw it yesterday on chapter 1, it said, you know, 150,000 or something like that. That will be the face amount for our policy. Deferred is when we withheld or postponed until a specified time or event in the future. So that's when you defer the payments, and you see more of that on annuities and retirement accounts, like when you're deferring to get paid or postponing. Deferido es como yo la vi, like lo dejas para después. How do you say that one? Endow? Okay. Endow is the cash value of the whole life policy has reached the contractual face amount. So when it has reached that face amount, when the cash value reaches the death benefit, basically that's when that has endowed, like it's reached the maximum in it. The level premium is a premium that does not change throughout the life of a policy. So that's your monthly payments. Premium is known as, you know, la prima, el pago mensual. So level means it's leveled. It's literally like that. When it's level, it's like a un solo nivel. So that payment does not change. Okay. Liquidation of an estate, it's converting a person's net worth into cash flow. So when you liquidate, you're trying to get your assets into cash. Es algo líquido, como para usar ahora. Algo fluido. So like liquidation of an estate, it's like if you have houses, if you have cars, if you have properties, but you want to liquidate it, it just technically simply means sell it because you need cash or because you want the cash, whether you need it or you want it, you're turning it into cash, for cash flow. Non-forfeiture values, benefits in a life insurance policy that the policy owner cannot lose even if the policy is surrendered or lapses. We're going to see more of that later on. Policy maturity in life policies, the time when the face value is paid out. It's matured when it's paid. Está en la cobija del baby because he will destroy it. It's just little Tank being malcriadito. Securities is a financial instrument that may trade for value. So the stock, bonds, options, things like that. So those are the securities in it. So term insurance is like our basically only product for life insurance when it comes to us primarily, but term insurance means that it's insurance for a term of time. And that's how basically you can differentiate, because its term is what I say, es a término. If it's a 30-year, a 20-year, a 10-year, it's a term. You have the insurance for that time. If that time already expires, then you can renew your policy and they'll let you know, hey, it's time for renewal. This will be your new monthly premium. Do you still want the policy? Like, you know, do you want to renew it or not? But you have up to, like, you know, they'll let you know, but it's term. Whole life that we're going to see later on. Whole life, it's for your whole life. Completely. Like that's literally what it means. Whole life until the day you die, you're covered. Term life for the term that you're purchasing. Term insurance provides what is known as pure death protection. Purely covers you if you die. That's basically what that means. Only if you die. So the insured dies during the term, the policy pays a death benefit to the beneficiary. If the policy is canceled or expires prior to the insurance death, nothing is payable at the end of the term, and there is no cash value or living benefits. So when it comes to living benefits, if we remember the cash value or the whole life policy, it has that cash account that you can always pull depending what you need or what you want. And we know there's interest and things like that on it, but you have that benefit. With this type of policies, there is no living benefit in it. So term insurance provides the greatest amount of coverage for the lowest premium, because you're only buying your insurance. Since you're not buying that savings account, then it's a lot more cost effective to have your life insured. And term insurance, again, has no cash value. So if you can remember those things when the question comes in, like what type of insurance is this? And it does not mention cash value, it's level premium, and it's for a specific amount of time, then it's term insurance. That specific amount of time, it's always term. Okay, so types, there's 3 basic types of term insurance available based on how the face amount or the death benefit changes during the policy term. So you have the level, which is the one that we talked about. We have the increasing and we have the decreasing. So the increasing one is basically the one, well, the first one that you see is the face amount. Premium, the ones that, if you own a policy through Pramerica right now, this is the one that we have. Level term face amount. We pay the same amount of premium for the years that we bought that insurance, right? It doesn't go up unless we require or we want more coverage. It's the most common, it's level, does not change. It keeps it all nice and easy. Now the annually renewable term, this is the increasing one. So you keep the same death benefit, but every year you're renewing your life insurance and you're paying a little bit more. So it's leveled only for that year. It's also called ART or ART, which is the annual renewable term. So it's the purest form of term insurance. This is very common when it's through a job. Those are the ones that are common through there. You have the death benefit, but then every year you're renewing the policy. The death benefit remains level. So your death benefit does not change. If you have a 500,000 policy or a 350 or 150, that benefit does not change. That's what makes it a level term, even though every year the premium is changing. The policy may be guaranteed to be renewable each year without proof of insurability, but the premium increases annually according to attained age. So this year I'm paying a premium of 35. Next year I'll pay the premium of 36. The following of 37. So that's changing every year because I'm renewing my insurance every year. However, my death benefits, it's still the same one. Okay. Decrease in term, it's a lot of kind of words in here. I always see it as a mortgage. Like that's the best way to explain a decrease in term benefits. So my benefit is the house, my payments, I pay every month, but then the balance of it, that benefit ends up being 0 at the end of the terms that I have. So you pay, and the benefit goes down, down, and down, and down. I don't see how a decrease in term policy is usually convertible. However, it's usually not renewable since the death benefit is 0 at the end of the policy. So once you're done paying it, then you're done with that insurance. What I was going to say is I don't see how this will be type of life insurance per se, I know it's a term insurance because it's mortgage. Mortgage is decreasing term insurance for the property, right? I don't think there is ever a life insurance that's decreasing, if that makes any sense. But I know it's a type of insurance, and this chapter covers all kind of insurance and concepts. So that's why they put it in here. Amortization schedule, like any car payments and things like that, will be decreasing as well. Because you're paying every month, and at the end of the contract, you owe zero amount. Okay, return of premium, an ROP, is life insurance, is an increasing term insurance policy that pays an additional death benefit to the beneficiary equal to the amount of the premiums paid. So that's when you died within a specified period of time, you get a death benefit, and then you also get anything and everything you paid. So these ones are structured to consider the low risk factor of a term policy, but at a significant increase in premium cost, sometimes as much as 25% or 50% or more of the insurance. So since we offer low term, like low cost, we wouldn't offer this type of life insurance policy, which is a return of premium. Normally they're more expensive because then the company has to pay you the benefit plus the premium that you've paid in. It says, but if the insured remains healthy and is still alive once the term limit expires, the insurance company guarantees a return of premium. However, since the amount returned equals the amount paid in, the return of premiums are not taxable. So I'm buying a term insurance for 20 years. I want the return of premium. So I'm going to pay in or pay for my insurance about 25 to 50% of my benefits. If at the end of those 20 years I did not die, then the company guarantees that they're going to pay me everything I paid in. You know, so they're a lot more expensive and not as common as the other one. So, but if people can afford it, hey, you get your money back if nothing happens to you, right? So special features on a policy, most term insurance policies are renewable. They're also convertible, and they're renewable and convertible. So either the term policy will say you're both or you're either or. So a renewable provision allows the policy owner the right to renew the coverage at the expiration date without evidence of insurability. That means that, let's say I have a 30-year policy right now, 35. So let's say at the age of 60, when my policy is up for renewal, I'm guaranteed to be able to renew without showing any proof of insurability, without doing any medical records, medical backgrounds, blood, urine, none of that. So when your insurance policy says it's renewable, then that means that you'll be able to renew at the end of the term without going through all those medical background questions. Then obviously when you renew, your premium gets recalculated, and now you're paying not the same that you were paying before, but now you're paying based on attained age. So if I'm now 60, I'm paying a life insurance policy based on the age of 60 that I am, right? Convertible means the provision that provides the policy owner with the right to convert the policy to a permanent insurance policy without evidence of insurability. So you can convert it into a whole life policy without the medical records. So conversion is basically when you have one type of life insurance and you're going to change it into another type of life insurance, right? Renewable is when you're going to renew and keep the same terms of the insurance, like keep the same type of insurance that you have. Okay. Some of them may say they're both, they're convertible and renewable. But that's basically what they mean. Traditional whole life products, they're called permanent. It's a permanent life insurance, general term to refer to various forms of life insurance policy that build cash value and remain in effect for the entire life of the insured or until age 100, as long as the premium is paid. So if you keep paying your policy, you are insured until you're 100 or until you die. The most common type of permanent insurance is what it's called the whole life. I know right now they change it into a whole bunch of other terms like universal, index, variable. All those means everything that has a cash value attached or a savings account attached to it, it's a whole life product. So it's a permanent life insurance. There is no term in there. Whole life insurance provides lifetime protection and includes a savings element, so that cash value. They're also endowed at the insured's age of 100, which means we just saw endow. So it means that your savings account will match the death benefit when you're 100 years old. That's when you'll have both, which means the cash value created by the accumulation of premium is scheduled to equal the face amount of the policy at age 100. Let's say you have right now a policy that it gives you a death benefit of 250,000. You're in your 30s. By the age you're 100, that's when that savings account will reach the $250,000. So I know we now know better, and we know we can invest the money and get $250,000 way sooner than in 60 years or 7 years, right? But that's basically what those what the policy means. The following are characteristics of the whole life insurance. So if we think back to the characteristics of term, I don't know if anybody remembers them. So there's 3 types, but the characteristics of it, do you guys remember? So we had level increasing or decreasing, but pure, so temporary protection. I'm just trying to compare it so it's better. So term, we know it's temporary, we know it's level premium, and we know is there has no cash value. So let's go through the whole life characteristics and see if we can see what's similar and what's completely different. So when it comes to a question in the quiz or quizzes or the exam, then we know what's going to jump to our head and be like, okay, no, they're talking about the other one. Okay, so level premium, the premium for the whole life policy is based on the issue age. Therefore, it remains the same throughout the whole policy. So we know level premium is also on term. So that's something they have basically same, right? The level premium towards that, for that term in the term policy, you have the same premium. Whole life, you have the same premium throughout the whole until you're 100 years old. Death benefit is a guarantee and also remains level for life. That's another similarity with the other policy. The death benefit does not change as long as you keep that policy. The biggest difference is the next one, the cash value. So we know term policies do not have cash value, but the whole life products does. So cash value. The cash value created by the accumulation of premium is scheduled to equal the face amount of the policy when the insured reaches the age of 100, or it's the policy, which is the policy maturity date, and is paid out to the policy owner. Remember, the insured and the policy owner do not need to be the same person. Cash values are credited to the policy on a regular basis and have a guaranteed interest rate. So when they see that, they know they're generating interest, and that's how people kind of get excited for them. I just wanna, it's paid out to the policy owner. So the cash value. So remember how there is people that have, the ones that are paying are not the one that it's insured, right? Like I have let's say a whole life policy on my husband. I'm the policy owner, right? He is the insured. If he reaches 100 and he gets maturity dates, the company will pay me that cash value, but will pay it to me, not to him. So the owner of the policy, the person paying for the policy, it's not always the same as the insured of the policy. And the cash value will be paid to the policy owner. So whoever was given the checks and paying that premium is the one that's going to receive that benefit for the cash, okay? Living benefits, that's another thing that whole life has that term does not have. The policy owner can borrow against that cash value while the policy is in effect, or can receive the cash value when the policy is surrendered. The cash value, also called non-forfeiture value, does not usually accumulate until the 3rd policy year, and it grows tax deferred. So the cash value is like we've seen before, the first 2 years of it, you don't have any benefit or any cash or any savings. Like they start growing basically kind of at the 3rd, and then it grows tax deferred. So you're not paying taxes on that now. You're paying taxes on it later. So when you're trying to get that money out, that's when you'll be paying taxes. know this. So whole life insurance provides lifetime, which is permanent protection, and accumulate cash value. So that's kind of like the biggest differences when you're seeing the questions. If it says insurance for a term policy or for 20-year insurance, you know, that's term. It has an end date, like a period of time, and it does not have cash value. That's term life insurance policy. If it's a permanent, if it doesn't have an end date or it says until age 100 and it says accumulates cash value, then that's a whole life. So term and whole life, the biggest differences, okay? So now we go into the types of whole life. And I think this is when this chapter gets super confusing. Up to there, are we all good? Do we all kind of understand the things, right?
So far, yes.
Okay. So I think from here on is when everything starts going kind of like un arroz con menestra y carne y camarones y todo mezclado ahí que no debería ser. Right? Una mezcolanza or chobola. Yes. So let's go part by part so we kind of try to understand as much as we can. Again, try to just, you don't need to learn it word for word. It's basically just understand how the policies work. So don't get frustrated if you don't learn all the concepts, if you don't understand everything that needs to do. As long as you have kind of the basic concepts of it, you'll be able to pass the exam. Okay. And since from now on, like from this part on, we don't offer any of these products. So you don't have to feel bad about not understanding them 100%. Right? You'll understand them enough so help your customers and your clients, like show them the difference and what benefits the most, but you don't need to know all the details and everything that kind of involves in them. Okay. So the ordinary, siempre la D. Have you realized that? Sorry. Okay. The whole life, the face amount, the death benefit, we already know that. And you see how in this scenario, it starts showing you both. The face amount and death benefit, same thing, right? So you have level premium, and I love the chart because in the chart, it starts showing you kind of what it means, right? So think of this as your policy. So your issue age, whether it's 20, 35, 40, or whatever age you got the policy. So age 100, if you see a graph like this that says age 100, it's whole life. There's no term life that will carry you to 100, right? So whole life, now the cash value increases as time goes by because you're paying your premium, right? You're saving that money, cash value starts going up, your premium is the same, right? So this is kind of like the basic ordinary one that we have. It's also called a straight life, which is a basic whole life policy. The policy owner pays the premium from the time the policy is issued until the insured's death or age 100. So what happens if you, si cumples los 100 años, you no longer have to pay the policy, but your policy is still in effect. So they give you that you only pay until you're 100. Of the common whole life policy, straight life will have the lowest annual premium. So if you want something with cash value and they're looking for the cheapest option, this one will be it, right? Same premium, goes cash value, and it's straight life. So limited pay, and single premium life. Just by reading the title, do you get an idea of what basically it means? Just reading the title.
It's limited time.
So because it says limited pay, you're paying for a limited amount of time. It doesn't mean your coverage is limited. So even if you decide to pay it in 20 years because you want to pay it up fast, you still have coverage until the age of 100 or until you die. And single premium life, you're buying your life insurance in one payment. Right? So it's like just reading that is like pago limitado, right? Again, like in my head, like I put like pago limitado, pago por limitado tiempo. Pero my coverage is for the full time. Or single premium, una prima. Tengo que pagar una sola vez. Pero mi cobertura, it's until 100 or until the day I die. Exactly. Like it's to there. So I know the graph, I love graphs because again, that's my brain, but I know that sometimes the wording of it gets a little bit confusing on how it explains everything. So just think of that limited payment, paid up age, you paid up to a certain amount of time. Your premium is still level up to there, up to the years that you're paying. Your cash value will still increase, and your death benefit will still be until the age 100. So they'll still pay until that age. So unlike straight life, limited pay or limited pay whole life is designed so that the premiums for coverage will be completely paid up well before age 100. Some of the more common versions of limited pay life are 20 pay life, whereby coverage is completely paid for in 20 years, and life paid up at 65, whereby the coverage is completely paid up by the insured age by 65. So you might think, who will choose things like this, right? Who will want to pay more for those years? So if you really want whole life and you know you have your working age, like you're going to retire in 20 years, then you wouldn't mind paying a little bit more in those 20, because after retirement, you won't have that bill to pay. You know what I mean? So like in my head, I'm trying to think who will want to pay more, right? But if it's a benefit to them that after they know their cash flow, retirement, whatever, they want the less bills possible at the age of retirement, then they're going to try to pay that while in their working years and have esa seguridad, ese retiro, ese seguro de vida ahí, or that cash value. Same thing until the age 65. So if I want to be paid up at 65, I'll grab one that's 30 pay, right? Like I'll pay it in the next 30 years, but then I'll be covered until I die or until I'm 100. So that's what limited pay is. Now, they just mentioned those two options because those are the most common ones. Either you pay it in 20 years or you pay it up to the age of 65. That could mean 5 years, that could mean 10, that could mean, it's a case by case, obviously, depending on your age. So obviously, like we said, the premium will be higher, and then the cash value builds up faster. So if you're thinking, why does the cash value build up faster? Well, I'm paying more every year, right? Now I don't have to wait until 100 for that cash value and death benefit to match. Because if I'm giving it out, I'm giving money in more at a time, and after 20 years, I already gave everything in, that cash value will like completely increase at that time, right? Now, the next one is single premium. Single premium whole life, it's exactly what we just said before. It's designed to provide a level death benefit to the insured's age 100 for one-time lump sum payment. The policy is completely paid up after one premium and generates immediate cash. So as opposed to like the straight life or whole life that we have, in the first example that, you know, it says in there, you won't generate cash until after like the 3rd year. This one, as soon as you're paying it, you already have cash value. But you have cash value because you paid everything at once. Right? ¿Sí se entiende? Yeah, okay. So this is a nice chart. Again, I'm a sucker for this, the charts and the graphs. I like them. It's better than reading because you can kind of like quita todas las palabras que tienen que conectar la oración y te muestran lo importante. So term life, whole life, the type of protection, we know term life is temporary. It means it's based on the term that you bought your policy. Whole life is permanent until age 100. So that's one of the main differences. Premium, they're both level, depending which one you choose, whether it's 20 years, pay up at 65, or single life, whatever it is, it's level. Death benefit, the whole life is level. The death benefit does not change, does not increase, does not decrease. Term life, you have the level, you have the increasing, and then you have the decreasing. Okay? Living benefits for term that it's not available for whole life policy. You have the cash value because you have a savings account. You can do loans towards that, and you have the non-forfeiture values in it. Okay, now we go to the interest one. So did that part of whole life, the basic whole lives, se entendió? Right? The differences in those? Okay. So now when we go into the interest sensitive ones, we go into kind of the market sensitive, into those that put it in the stock market, adjustable life products. I think it's a little bit more confusing, but if we go part to part like we've done up to now, then I think we'll be good. So adjustable life was developed in an effort to provide the policy owner with the best of both worlds, term and permanent coverage. An adjustable life policy can assume the form of either term insurance or permanent insurance. The insured typically determines how much coverage is needed and the affordable amount of premium. The insurer will then determine the appropriate type of insurance to meet the insured's needs. As the insured's needs change, the policy owner can make adjustments to the policy. So typically the policy owner has the following option: increase or decrease the premium or the premium paying period, increase or decrease the face amount, or change the period of protection, right? So you can change or ask, hey, do I want to pay more? Like, do I want to pay for more time or less time? Do I want more or less benefit at, when I'm dying? Or do I want it for 20 years, 30 years, or do I want it for my whole life? So that's the three things that you can change in the adjustable life. The policy owner also has the option of converting from term to whole life or vice versa. However, increases in the death benefit or changing to a lower premium type of policy will usually require proof of insurability. In case of converting from a whole life policy to a term policy, the insurer may adjust the death benefit. The policy owner may also pay additional premiums above and beyond what is required under the permanent form in order to accumulate greater cash value or to shorten the premium paying period. So that's basically kind of what we said before. If you pay more, cash value increases, or you can pay more now to pay during less time, right? So you can adjust those. If you want to increase your death benefit, salud.
Yes.
If you want to increase them, then you have to prove insurability when you're under the adjustable life.
But that one's pretty simple because increase and decrease, you can always adjust what you want in your life. So that one is pretty okay.
Yes. Now, universal life. Universal life insurance is also known by the generic name of flexible premium adjustable life. And when they start putting all these names around, that's when things get confusing. Just leave it at universal.
Yeah, you see when it says adjustable now, you see?
Yeah, exactly. So flexible premium adjustable life will be the universal life, okay? So that implies that the policy owner has the flexibility to increase the amount of premium paid into the policy and to later decrease it again. So in the adjustable life that we just saw, you have the options, but you have these options when you're setting up your policy, like increase or decrease the premium. Then if you want to do any of the changes, you have to convert it, right? And then you can choose if you want to pay more or less, or what are your needs at the time of conversion. The universal life gives you that flexibility of doing it, I guess, whenever you want to. It says, in fact, the policy owner may even skip paying a premium and the policy will not lapse as long as there is sufficient cash value at the time to cover the monthly deduction for cost of insurance. So if you stop paying your insurance, but there is, or your premium, but there is enough cash value on that account, they'll simply just take it from your savings and pay your policy. All right, so without even asking, that's kind of like one of the things. Hey, it's okay, don't pay me. And then when you go realize there's no savings because it's paid all your insurance in there. So thanks for this one. Since the premiums can be adjusted, insurance companies may give the policy owner a choice to pay either the two types of premium. So the minimum premium is the amount needed to keep the policy in force for the current year. Paying the minimum premium will make the policy perform as an annual renewable term product. So do you guys remember the annually renewable term product? It's from the term policies. It has no cash value. Remember? Yeah. So the company here, and this is, how they get you. Hey, Universal Life, you have cash value. But hey, you can pay it as a minimum premium. and everybody's gonna be like, hey, I want to pay the minimum possible. That's super cool. You pay the minimum, there is not enough money remainder to go into that savings account. It's all going for that insurance. Right? The target premium is the recommended amount that should be paid on a policy in order to cover the cost of the insurance protection and to keep the policy in force throughout its lifetime. So that will give you enough to cover the insurance, make sure there's always money there, make sure you have your savings account, like you're covered for anything. So things to know about these two policies: if an insurer skips a premium payment on a universal life policy, the missing premium may be deducted from the policy's cash value. So the policy will not lapse. Okay. So I'm going to play this little video. It's a universal life policy, has two components, an insurance component and a cash component. The insurance component of a universal life policy is always annual renewable term insurance. So think there is different, which is a type of whole life. It's a universal. So whole life also has the insurance and the cash, right? The difference with the universal life is that it's an annual renewable term insurance, which if we saw before, every year that premium is going up, right? So every year it's like a term insurance with cash value, and they call it this universal value policy. It's technically a whole sancocho in there, right? They're mixing the term with the cash value. Pero te lo dicen, hey, it's annual renewable term, which means it's level for 1 year, then the premium increases, level, and increases, and every year you're renewing it. Every year you're renewing it, so every year you're paying more in premium and less in cash value, right? So I'm gonna play this to help a bit. Let me know if you guys can hear it, because I don't know if I share the sound. No? Okay. And then, give me 1 second. Not that one. I'm gonna go for the fastest share sound down here. No, share.
This illustration will help you to take a look at the components of a universal life policy and to better understand the relationships between them. Please note that this example provides hypothetical dollar amounts only to help you better understand the concepts. Mr. Insured pays $100 a month in premiums into his $100,000 universal life insurance policy. Normally, on the policy anniversary date, a guaranteed minimum interest of 4% is paid into the policy. However, this year, due to favorable market conditions, the policy's interest rate is 5.5%. These two elements, premium and interest, create the policy's cash value. This cash value pool is used not only to cover insurance costs, but also to provide certain benefits to Mr. Insured. Cash value pays for expenses such as administrative costs, commissions, and other policy charges. Mr. Insured can pay for a term policy to provide an additional protection element, or he can take out loans and make partial withdrawals from the cash value. He may adjust the amount of the premium, the amount of the death benefit, and may even skip premium payments. However, Mr. Insured has to keep in mind that the cash value maintained in the policy account needs to support all of these costs to avoid policy lapsing.
Right, was that good? To see what happened when they stop paying premium? Like
Yes.
they're showing you the cash value starts going down. Because from there, you're paying everything. You're paying your fees, your commissions, like everything gets paid from there. And then you do get that interest option of it, right? But at a certain point, the interest by itself won't be enough to cover everything, right? To cover the administrative fees, to cover your insurance. And then if you have any money that you've withdrawn or loans outstanding, you know, that in there as well. So I like that with the water. It makes it more understandable. So universal life policies allow partial withdrawal or which is partial surrender of the policy cash value. However, there may be a charge for each withdrawal, and are usual limits as to how much and how often you can take money out. So during the withdrawal, the interest earned on the withdrawn cash value may be subject to taxation, depending upon the plan. The death benefit will be reduced by the amount of any partial surrender. So to make this a lot easier to understand, let's say you have your policy and you have cash value and you've withdrawn $20,000 of your cash, right? Your policy was for 150,000 and you have 20,000 outstanding. Let's say with fees and policies and interest and all that comes to 25 that you owe the company. Something happens to you, your family will receive your death benefit minus any loans outstanding that you have. Okay, so that's basically what it says. Now, it also has limits on the amount that you can take out. Because you have cash value of 100,000, does not mean they're going to allow you to take the full $100,000. Depending on the policy, on the interest, and anything like that, is the amount that you'll be able to take. Now, most of these policies, you're paying them, or sometimes you choose to pay them after tax, right? So you're paying them from your account after tax. So that's already tax paid, basically, right? So if you take the money out, like let's say you take $20,000 out, $18,000 might not be taxable because that's part of the premium that you put in. Maybe just $2,000 because that's interest. So you'll pay taxes only on the interest that you earned at the moment that you withdraw the amount. Okay. So Universal Life has two options, option A or option B. And so option A is the level death benefit option, and option B is the increase in death benefit. So option A is level, option B is increasing. You see the graphs here?
Yeah.
So pure insurance, and you have like this line completely just go through it, right? That's option A. Option B, the benefit, you see it going up in here. So option A, it's the level death benefit option. The death benefit remains level while the cash value gradually increases, thereby lowering the pure insurance with the insurer in the later years. So it lowers that insurance, but then you have the cash value increasing in there. Now, option B is increasing death benefit option. The death benefit includes the annual increase in cash value so that the death benefit gradually increases each year by the amount that the cash value increases. That's basically what you have to know. Option A, death benefit option is level. Option B, the death benefit increases with it. Okay. They also, and I did see the word corridor. Oh, no.
Corridor.
Yes, what she said. I don't know if you heard her, but if you can read this word, I can never, mi lengua se me traba. If you see that, which I did see in the exam, and then it's the question said something about this, and then it said which universal insurance was it option A, was it option B, was it whole life, was it term life, something like that. So if you see this word, it's automatically universal option A. Always. It's universal option A.
And how would they ask about option B? Have you seen that?
I didn't, but they could ask you which is the universal type in which the death benefit increases every year. Or as the cash value increases, the death benefit is also increasing. What type of policy will that be? And that'll be option B. So it says, look at this, at any point in time, the total death benefit will always be equal to the face amount of the policy plus the current amount of cash value. Since the pure insurance with the insurer remains level for life, the expenses of these options are much greater than those for option A, thereby causing the cash value to be lower in the older years, because all those expenses gets paid out of that cash value. So you see how the cash value over here kind of remains lower than the death benefit. They're increasing at the same time, but it remains way lower than the other one. And this one, it kind of like goes up there. It's almost kind of, yeah, it's almost the same in there. So option B is also more expensive because of it. Okay, so variable whole life. variable life insurance, sometimes referred to as a variable whole life insurance, is a level fixed premium investment based product. So some sort of level fixed investment based product. So like traditional forms of life insurance, these policies have fixed premiums and a guaranteed minimum death benefit. The cash value of the policy, however, it's not guaranteed and it fluctuates with the performance of the portfolio in which the premiums have been invested. So in variable contract, the policy owner bears the investment risk. So if you're a way to think this, you're the owner of the variable life, right? You have, it's level in what you're paying, you have a fixed premium, but you're investing certain type of money, right? And because you're investing and you're deciding which portfolios you're going to invest, then you can lose the money. Like it's not guaranteed that you're going to make money on those investments. So in this type of account, they're keeping everything separate. You see this universal account over here, both monies go into the same cup. And then from that cup, it's like, this is one account, both cash, the interest and the premiums get deposited into one. And from that account, it gets paid out. On the variable ones, you have different accounts. So for the insurance gets deposited into one account, meaning this amount can be touched. Those are premiums. And then your other one, the one that you're going to invest, is in a separate account. So you as a policy owner, because you're deciding where you're kind of investing that amount and there's no guarantee in it, you have the risk of losing this money over here, right? Just like in the marketplace. So that's kind of to know about the variable life. Now, on the variable whole life, you also have the variable universal life. And again, yo creo que si pusieran otras palabras diferentes sería más fácil, pero como combinan todas las palabras.
Sí, ya como que está un poquito más complicadito. Right? Yes.
Okay, so we understood the part for term life. We have that down pack. We have whole life down pack, right? Now, after whole life, we had the adjustable life, which is you can adjust what you want.
Yes.
And we have the universal life, right? With the minimum premium and the target premium. Ahí está bien. Inside the universal, you have two options, option A and option B. So option A is your level death benefit or corridor. I think that's something like that. Yeah. And option B, it's the increase in death benefit. Right? So you have those. Option A is more affordable. Option B has more fees and things like that you're going to see in the older years coming out of your cash value. So we have those. Now the variable life, it's two separate, it gets deposited into two separate accounts. You have your insurance account and you have your cash valued account. And then there's no guarantees. So you have the risk of losing that investment. Right? Now we're going on to the next one, which is a variable universal life. So variable universal life insurance is a type of insurance that combines many features. And that's why it has a combination in the name, because it combines of the whole life with the flexible premium of universal life and the investment component of a variable life, making it a securities version of the universal life insurance. So when we thought about the universal life insurance up here, right, when we're doing universal life policy, we're just paying into this one and it was given us interest, but we weren't deciding where it was going to be going. We just paid it to the insurance company. The insurance company said, hey, we're going to pay you 4 or whatever the rate is in the market. If it's more, we pay you more. If not, the lower you'll get is 4%, right? That's in the universal. Now on this one, it's getting that kind of flexibility, the variable universal life. But it's also saying, hey, we're going with the variable option as well. So we're getting the universal that has that flexible premium. Now from the variable, we're getting the investment portion of it. So we can invest into the portfolios that we want, which makes it a securities version of the universal life insurance. So it's like thinking about the universal life, but now you have the option to invest that money, and therefore you have 2 accounts in there, right? So it's a flexible premium that can be increased decreased, or skipped as long as there is enough value in the policy to fund the death benefit. It's increasing and decreasing the amount of insurance and cash withdrawals or policy loans. So it's grabbing from the variable and the whole life. So it's gonna be really kind of like, when you come across these questions, you'll have to like really read them slow and see exactly what they're asking, because these are the ones that are gonna be confusing.
Because they're asking basically the same thing that we just study on top, but now
They're combining them. So we saw variable life, right? The variable was the ones that have the 2 separate accounts you can invest. I have the risk because I'm the owner and I'm paying and I can lose this money, right? And we saw the universal life that has a cash value in it. I have no risk. I have a guaranteed percentage that I'm going to be paid in, and I can take loans and things like that. And now this one, it's like saying, hey, you have all of them combined. Like all those choices they had. So now difference, unlike universal life, most of the investment vehicles in variable universal life policies do not guarantee return. Right? So what we saw in the universal lives on top, remember they said, hey, we give you 4%, or if the market is higher. So you have a guaranteed return on your money, right? When you now combine the word universal with variable, now that guarantee is no longer there. It's not a guarantee that you're going to make an interest or you're going to make money on that investment. Okay. Variable life insurance products are dually regulated by the state and the federal government, because now you have like 2 or 3 type of products in there. Due to the element of investment risk, the federal government has declared that variable contracts are securities and are thus regulated by the Securities and Exchange Commission, which is the SEC, and the Financial Industry Regulatory Authority, which is FINRA. Yeah. Variable life insurance is also regulated by the insurance department as an insurance product. So you have different products in there, not just the cash value and the insurance, but now because the cash value is being invested and you kind of decide where to invest it, now it's also securities and you get more departments guaranteeing and overseeing it involved. Yes. Agents selling variable life insurance products must be registered with FINRA, be licensed by the state to sell insurance, and have received their security licenses. So for example, I cannot sell these type of products because I do not have my Series 6 yet. Once I pass that exam, then I'll be able to sell annuities and retirement accounts and things like that.
So basically, variable universal life insurance has everything.
It has everything included, correct. Everything included. So we know that Pramerica does not have those products. We only have term. But we know we only have term because we tell our clients buy term and invest the difference. So for us, we'll still need that security license to help them invest that difference into mutual funds and other accounts that they choose. But for this type of life insurance, whoever sells this type needs to have all those licenses. Now we are, I was going to say almost done, but holy moly. Oh yeah, we're just starting. Well, nice. Perfect. Interest sensitive whole life. Interest sensitive whole life is also referred as current assumption life. It's a whole life policy that provides a guaranteed death benefit to age 100. The interest sensitive whole life provides the same benefit as other traditional whole life policies, with the added benefit of current interest rates, which may allow for either greater cash value accumulation or a shorter premium paying period. So basically they're using that interest earned, the higher interest, to either have more money in there or to pay their life insurance faster, like use it to pay the policy. Index life, the main feature of index whole life or equity index whole life insurance is that the cash value is dependent upon the performance of the equity index, such as SP 500. Anytime you see SP 500 is index life. You won't see it in the other ones. So although there is a guaranteed minimum interest rate, the policy's face amount increases annually to keep pace with inflation. So it increases annually to keep with inflation, without requiring evidence of insurability. Index whole life policies are classified depending on whether the policy owner or the insurer assumes the inflation risk. If the policy owner assumes the risk, the policy premiums increases with the increases in the face amount. If the insurer assumes the risk, the premium remains level. So, si el asegurador o el asegurado, so si eres el asegurador, which is, el asegurador es la compañía. So if they're assuming the risk for it, that means it's coming out of the interest or cash value and your premiums are level. If you're assuming the risk, then you're paying kind of the different premiums. When they tell you it increases, you're paying that increment in there. So now this is the charts that I like. Adjustable life insurance, which permits changes on the face amount, premium amount, period of protection, and the duration of premium payment period. If you want to take a screenshot, or actually, I think I can take a screenshot of this thing and send it through WhatsApp.
Yes.
So you can, and let me copy. I'm going to send it a flow, okay?
No, I stayed a little confused with the index whole life.
Okay, so what, do you have a question? Why isn't that?
Oh.
Oh, continue now. Mm-hmm. Okay, so index whole life, the cash value that it has, it depends on the market, on the equity index.
Okay, so basically, if they get that, it all depends on the market. It's like a investment kind of thing.
It's an investment, but the difference between this one and the other one, the policy on, and when I say other one, I mean the variable universal life or the variable life itself, it doesn't have any guaranteed. The index life, it does have a guaranteed interest rate in it, a minimum one. And I think the minimum, honestly, when I saw one of the policies, said 2%. So it's either at least 2% or whatever, however the market is doing in it. So you have the difference. So you're not losing your money per se, like 100%. There's always
So
a
if it's like, okay.
Mhm. So adjustable life, you have key features on it, can be term or whole life, can be converted to one from one to the other. The premium can be increased or decreased by policy owners. The face amount is flexible, set by policy owner with proof of insurability. So obviously, if I want $5 million of face amount, I need to show that I'm healthy and that I'm not dying tomorrow. The cash value is fixed rate of return into a general account, which means fixed rate of return in general account. It means the insurance and the cash value goes into that same account. Policy loans, you can borrow from your cash. Universal as well, it has permanent insurance with renewable term protection component. The premium is flexible. This is the one that has a minimum and the target. So minimum at least keeps with insurance cost. The target will keep you having that cash value and making sure you're always covered and there is no lapse. Your face amount is flexible, set by policy owner with proof of insurability. You have cash value guaranteed at a minimum level into that general account. And so if you see questions of general accounts, you're going to know if they can be talking about adjustable or universal, right? So you have to read the question to see which one else they could be referring to. If they talk about separate accounts, you know they're talking about a variable life. That's the one that has separate accounts, because since the return is not guaranteed, they need all that money to be able to see, hey, did you make money or did you lose money? So you need all that money into a separate bank account. A variable life is a permanent life insurance. It's fixed if whole life, and it's flexible if it's a universal one. So if you read flexible variable life, that's the universal. That's why there's only 3 options in here. And we read like a few more up there because they had by itself the variable universal life. So the only difference between variable universal life and just a variable life, it's that the universal life, the premium is flexible. Face amount can increase, decrease, or decrease to a stated minimum, again, to cover the fees for everything. Cash value is not guaranteed. So the cash value in here, the variable life, as opposed to the universal and adjustable, has separate accounts. And it's mainly because that cash value, it's not a guarantee. It's basically a toss-up. If the market did good, then you get money. If not, then you lose the money. Policy loans, you can borrow against that cash value if you have cash value in there. Now we have a combination of plans and variations. Do you want me to stop? Do you guys have any questions? No? I wish there was
It
like a
looks like we're
quiz
gonna.
that will take up to there. You know what I mean? Like that will not test the whole thing. But does that do oh, it's because I'm on combinations in there. So hold on. Let me go up over here and let me do a practice question. Yeah. Okay. Oh, te da pregunta de lo que estás. So let's do a few questions up to there. Let me go up again and let's see how we're doing so far. Because I know this is, after this chapter, everything goes smoother. This is a lot. This chapter it's a lot of concepts technically. Okay. So which of the following types of insurance policies will provide the greatest amount of protection for a temporary period during which an insured will have limited financial resources? Will it be term, whole life, annuity, or variable life? Correct. So Ellie says if it says temporary, is term. Do we agree?
Yes.
Yep. Okay. So let's choose term. Yes, we're right. So that's one of the things that you can see, those keywords in that question that will give away the answers to the questions, okay? Always the recommendation is read question twice, eliminate two options, and then go with your gut feeling. Not to overthink it, but that was a given when it said temporary. Let me scroll a little bit more down and see if we get another one. It says a policy will pay the death benefit if the insured dies during the 20-year premium paying period, and nothing if death occurs after the 20-year period. What type of policy is this? So again, a policy will pay the death benefit if the insured dies during the 20-year premium paying period, and nothing if death occurs after the 20-year period. What type of policy is this? So level term, Patty, Mildred, Alvaro, do you guys have any other answer you wanna
I said level term.
You said level? Okay.
Level term too.
Level. Because I'm hearing level, I'm gonna go with level. Look at you ladies, huh? The 20-year term policy is written to provide a level death benefit for 20 years. So again, it's level. So what gave it up is you have, it's a temporary, it says, period. So if they're not, so for me, like this one got confusing with the limited pay whole life because he said they're like 20, pay 20 or 20-year premium paying period. You know, 20 pay that we saw a little while ago. But the 20 pay in whole life, you'll be covered until your age 100, even if you paid it into 20 years. So this one, what gave it up is that died after the 20, you don't get anything after you finish paying. That means you're a type of term policy in there, okay? So let's go a little bit more down, see if here we get another one. Which of the following is not one of the three types of term coverage based on what happens to the face amount during the policy term? So level.
See?
I like this. I like the, okay, we're getting there. Perfect. Renewable. So we said the term coverage, we have level, increasing or decreasing, right? Perfect. So renewable is just a condition. You can either renew it or you can convert the policy. Perfect. Let's go down a little bit more. A policy will pay the death benefit if the insured dies during the 20-year premium paying period and nothing. We just saw this one.
You just saw that.
Yep, okay. So let me do a little bit more down and see if it changes the question. Okay, yes. Which of the following is incorrect regarding 100,000 20-year level term policy? So at the end of 20 years, the policy cash value will equal 100,000. Remember, we're looking for the wrong answer, okay? The policy premiums will remain level for 20 years. C, if the insured dies before the policy expired, the beneficiary will receive the 100,000. D, the policy will expire at the end of the 20-year period.
Incorrect. I believe it's D. Not sure, but I think it's D.
Okay, you're saying it's which one, Tati?
The policy will expire at the end of the 20-year period.
Okay.
Because isn't don't they still get don't they still get whole life? I mean, not whole life, but do they
Okay, so
still get it?
Does it have cash value?
yeah, but what Ellie's saying, I don't know if you can hear her, is that term life
Okay.
doesn't have cash value.
True.
So look at your question. So we're looking for the incorrect answer, right? And it says, which of the following is incorrect regarding 100,000 20-year level term policy? So if it says
So it's
level,
A.
Oh, A, because cash value.
correct. So your answer will be A because it automatically shows the cash value in there.
Good job, Ellie.
Yeah, we're passing that exam. I'm excited. Okay, so let me go a little bit more down. Okay, we just saw
Thank
that
you.
one. Yeah, let me try to move it. Okay, which of the following best describes annual renewable term insurance? A, it provides an annually increasing death benefit. B, it is level term insurance. C, it requires proof of insurability at each renewal. D, neither the premium nor the death benefit is affected by the insurer's age. Which one do you guys think? Or remember, actually?
I think we will be sure that
Which is that one?
it's not that one. You can say it requires premium for the loan.
Okay, so you're automatically, taking that out. So we're taking C out of the running because we remember annually renewable term, it does not require proof of insurability at any renewal. So we're
And
taking C.
level, yeah, and taking out B because level term insurance was not the renewable one.
Well, read the question. It says annual renewable term insurance. So if you remember the graph, and this is what I love the graph. It's level for a year, then it goes up, then it's level again, then it goes up, then it's level again, then it goes up, then it's level again. It increases your premiums. So it increases your premium every year. However, it does not increase your death benefit. The death benefit remains the same. So we can take neither the premium nor the death benefit is affected by the insurer's age. So the death benefit does not change, but the premium does. So it's not D. I actually think it's B. It is type of a level term insurance. And I'm gonna go back up to that graph to show you.
Okay.
So an annual renewable term is a form of level term insurance. So basically the given, if we keep annual renewable term, like remember these options over here? Annual renewable term. So your death benefit, it's always the same. It's the purest form of term insurance. Death benefit remains level. The policy may guarantee to be renewable each year without proof of insurability, but the premium increases based on your attained age, since the probability of death increases. So you're a year older, most likely you're closer to dying, so your premium goes higher. Okay? So that was a good one to go back to. Okay. What does level refer to in level term insurance? Will that be the premium, the cash value, the interest rate, or the face amount? So automatically, what's the one that you can eliminate right off the bat?
Cash value.
Cash value, because it's term insurance, correct. You can take it right off it. So what does level refer to in level term insurance?
Face amount.
And we just saw it in the annually level, right? It was level during which part of the graph? It was level on the debt, and it was level also on the premium. Right, so can I move the little thing? Do you guys want me to try to do face? Is that what you guys are thinking? So we know B and C are not there because it's not cash value, it doesn't have an interest rate. Those two are completely out of the running. Do you guys think it's level because it refers to level to a level premium, or because it refers to a face amount?
I don't know. I think it's face amount. I'm not sure.
That's one of the annual term insurance, but you say face? What did you say? Okay. There you go. I'm here trying to confuse you. You ladies are like, no, I know it's face amount. Good job. So level term policies maintain level death benefit or face amount throughout the term of the policy. In the level term insurance, the premium also remains consistent over the years, unlike the premiums of many policies, which increases as the policyholder ages. Very good. A little bit more down, see another question. Annually renewable term policies provide a level death benefit for a premium that increases annually, decreases annually, remains level, or fluctuates.
But we just seen that renewable, the premium kept increasing based on the age.
Okay, so Ellie says it's A. Read again the question, like annual renewable term. So we're renewing our policy every year.
So according to the graph, what I have in my head in the graph, it was leveling up according to the premium. It kept increasing because of my age.
Correct. So your premium increases annually. Perfect. That's why I said, like, some people have photographic memories, which I know it's the case of Al. And when it comes to graphs, I kind of remember them as well. So look at the graphs always. And if you have to draw them a few times so you can get them, that will help as well. Like if you have to go back and check the graphs. I'll do just a little bit and see if we get another question. I think we already did this one. Which of the following is incorrect regarding a 100,000 20-year policy? So let me do a little bit more and go into the funny ones. All of the following are true regarding the convertible option under a term life insurance policy, except. So we're looking for the wrong answer. Okay. All of the following are true regarding the convertible option under a term life insurance policy, except. Evidence of insurability is not required. Most term policies contain a convertible option. Upon conversion, the premium for the permanent policy will be based upon attained age. D, upon conversion, the death benefit of the permanent policy will be reduced by 50%. What do you guys think?
If I'm not wrong.
Yeah, which one do you think is wrong? Ellie says D. Right? Okay, it's not D.
I think the one that is correct is the A. Do we have to show true every time we are converting?
I'm sorry, I couldn't hear you. What you said?
I think it's A. Do we have to show insurability every time we convert? That's something I didn't see.
That's a good one. Evidence of insurability is not required when we convert. So Tatiana is thinking that she doesn't remember seeing that, so maybe it is required when we convert the insurance.
We talked about converting, but I don't see
Yeah,
I
the
think
insurability. I
the,
get it. Let's see, most term policies contain a convertibility option. I see that being true. Upon conversion, the premium for the permanent policy will be based upon attained age. Yes, upon conversion, the death benefit of the permanent policy will be reduced by 50. That one has me confused. You guys want me to click A, or it could be D?
I think it might be D. I don't remember that being reduced by 50%.
Right, I know it was something about a reduction, but it's, I don't remember 50. Well, let's try D and see how it goes.
Yeah. Ellie, she's ready for this test. She just doubted herself.
I'm telling you, she's ready. We're about to do those things and schedule it. Perfect. And so convertible term insurance is convertible without proof of insurance up to the full term death benefit. However, upon conversion, the premium for the permanent policy will be based on the insurer's attained age. Nothing about reducing that death benefit. Right? You don't lose that version. Let me do a little bit more down. See if we got a different one. Okay. Which of the following is not a type of whole life insurance? So Ellie says C.
Yeah, she is the one that.
Yeah, see.
Perfect. There we go. So let's go a little bit more down. In which of the following cases will the insured be able to receive the full face amount from a whole life policy? If the insured lives to age 100, B, as soon as the cash value exceeds the face amount, C, if there are no named beneficiaries when the policy is paid up, D, at age 65.
And an A?
Okay.
Good job. Well, let's see. Yes, good job. So if you turn to 100 years old, they automatically give you your death benefit, your full face amount. They're like, good job for living this long, go and live life.
At 100.
At 100, exactly. All right, which of the following policies will be classified as a traditional level premium contract? Traditional level premium contract. Straight life, adjustable life, universal life, variable universal life. Which one do you guys think?
I am not 100% on this one, and I am very confused, but I'm going to go with a D. But I think that's wrong. So you might need to ask Miss Ellie over there that she's ready.
Which of the loan policies will be? Okay, so Ellie thinks it's straight life. So we have straight life, adjustable, universal, variable, universal life. The question says, which of the following policies will be classified as traditional level premium contract?
Traditional level premium. Remember that one, to be honest.
Okay, so you want me to just try straight life?
What she said.
Or continuous premium whole life? Life policies will have the lowest annual premium. I think it will be something. So we're thinking not straight line. Traditional level premium contract. Will be higher.
That's not being
And adjustable if you can adjust it. I do think you're right though. Because I have level premium, the straight. What you're thinking. Who else said D? Did anybody say D? You say D? Which one are you thinking?
I think D also.
You think D also? Okay, let's click D and let's see how it goes. Again, we don't need to be right. We just need to kind of see if we're understanding. No, it was straight life.
Ellie.
Ellie was right. Yeah, straight life policies have level guaranteed face amount and a level premium for the life of the insured. So traditional level premium contract, all the other ones we can kind of, fluctuates or miss a payment and things like that. So the straight life is kind of the simplest of it. Let me see if it puts another one. Okay. An insured has a life insurance policy that requires him to only pay premiums for a specified number of years until the policy is paid up. What kind of policy is it? Is it adjustable life? Is it graded premium life? Is it limited pay life? Or is it variable life?
Limited pay life? Wasn't that the one that you pay a certain amount until it's paid?
You paid a certain amount per month for a certain amount of years, and that pays the full policy. Yes. Perfect. Let's see if it gives another one just to make sure. I think so. Okay. An insurance policy that only requires payment of premium at its inception provides insurance protection for the life of the insured and matures at the insured's age 100 is called level term, graded premium, single premium whole life, or modified endowment contract. So requires a payment of premium at its inception, meaning at the beginning. When you sign the contract, that's when it requires the payment.
B.
Mildred,
We know it's not A or D.
okay. So if you're
Single premium whole life.
exactly, because you're paying it once you're signing that contract, and then you're not paying again. It's a one-time payment. Yeah. It's a one-time payment. Okay. Let's go another one just to practice a little bit more. Okay. Under a 20-pay whole life policy, in order for the policy to pay the death benefit to a beneficiary, the premiums must be paid for at least 20 years until the policy owner's age is 100 when the policy matures, for 20 years or until death, whichever occurs first, or until the policy owner reaches age 65. So again, you're not limited pay, you're paying your policy for 20 years, it's a whole life policy. In order for the policy to pay the death benefit to the beneficiary, the premiums must be paid how or up to when? So Ellie thinks it's C.
I think it's C also.
Perfect. So not to confuse anybody, they can see a lot of mumbo jumbo in these insurance policies. The moment you make that first payment and you're not letting it lapse, you're covered. So if it says you have to pay for 20 or 30 years, but you die within 5, they'll pay your death benefit. Okay? It's whatever happens first in there. You guys want to try another one? Let me do a little bit of scrolling and see what we get. Okay. Your client wants both protection and savings from the insurance and is willing to pay premiums until retirement at age 65. What would be the right policy for this client? So you have increasing term.
Limited pay whole life?
You have limited pay whole life, interest sensitive whole life, and life annuity with period certain. No, we haven't. So it's limited pay whole life like Tatiana says. Let's choose that one. Right. Perfect. That's the security.
Because he wants to pay till 65.
Correct. And that's the LP 65. You can choose to pay up to 65.
Oh, look.
And then it's right there. And then when I was explaining it, I also said the only way I see somebody choosing that, it's because they want to pay the years that they're working and then not pay their insurance when they're retired. Right, okay, so let's do a little bit more down, see if we get another nice question. Straight life policy has what type of premium? A level annual premium for the life of the insured, an increase in annual premium for the life of the insured, a decrease in annual premium for the life of the insured, or a variable annual premium for the life of the insured.
A level?
A.
Level A. Yes, ladies. Okay, good. Straight life, it's línea derechita. Nada cambia. A little bit more down. Let's see what other we get. Okay. Under a 20 pay whole life policy, I think we saw this one. Yes, we did. An insured has a life insurance policy that requires him to only pay premiums for a specified number of years until the policy is paid up. What kind of policy is it?
Limited.
Okay, yeah. Perfect. I just making sure you guys remember it. A little bit more down. You'll think it's funny, but the questions is not that they're word for word on the exam, but they're similar. So it's like if you get the concept of how to answer or like the relatable things, it will be easier on the exam.
No, but the more we practice it, the better. Actually.
Yes. Which type of life insurance policy generates immediate cash value? Level term, decreasing term, continuous premium, or single premium?
Single premium?
Right. Because the moment you paid everything, it gives it the cash to like grow. Perfect. Which of the following best defines target premium in a universal life policy? A, the recommended amount to keep the policy in force throughout its lifetime. B, the maximum amount the policy owner may pay on a policy. C, the minimum amount to make sure the policy is annually renewable. D, the corridor of insurance.
Okay.
They're trying to confuse people, but it's a recommended amount to keep it in force throughout the life. So it's going to include a little bit for those renewals and things like that, but it'll be good. Good job. Good job. Good job. The policy owner of a universal life policy might skip paying the premium and the policy will not lapse as long as A, the policy contains sufficient cash value to cover the cost of the insurance. B, the previous premium payments were high enough to create an excess of premium. C, the policy owner cannot skip premiums without the policy lapsing. D, the next month's premium is sufficient to cover both the current premium amount and the skipped amount.
A.
Sufficient cash value. Very good, ladies. Very, very good. Perfect. A little bit more down. The death protection component of universal life insurance is always annual renewable term, whole life, adjustable life, or decreasing term.
Whole life? Annually.
Annual renewable term. So universal policy has two components, an insurance component and the cash. The insurance component of a universal life, it's always annual renewable term. So let's see if we get, okay. During partial withdrawal from a universal life policy, which portion will be taxed?
Interest.
Perfect. ¿Alguien que lo diga en francés? No? Ellie said it in Spanish, you said it in English, so I'm like, somebody in French?
No, you're in the English, remember?
Like I'm barely bilingual. Okay, perfect. Interest. Let's see again. The death protection component of a universal life insurance is always annually renewable.
Annually.
Perfect. So it's
The death protection.
Got it. Good job. Let's go a little bit more. The death protection
That was the same.
Oh, okay. It's like I just saw you. Universal life insurance policy is best described as whole life policy with two premiums, target and minimum. flexible premium variable life policy, annual renewable term policy with a cash value account, or a variable life with a cash value account. So Ellie says the closest one she sees is B. We're talking about the universal life insurance. So these are the ones that has option A and option B. What do you guys think? Anybody else think something else?
Universal life.
I think we just saw that it was
C.
the other question. Tatiana says C. Right, Salud. C? Do we go with C? Everybody see? Let's see. Let's see, yeah. So it's another way of what it asks on the other side. It asks what type of insurance does the universal life, what insurance component does the universal life has, or universal life policy? And it was the annual renewable term. So now it's telling you what two components describes the universal life insurance policy. So now you have the annual renewable term policy and the cash value that it has.
Like even what for me was universal has cash value.
Yes. So it's a type of whole life. So universal, and every time you think universal, now that we saw the video, just think of the two llaves y el vaso de agua. So tienes el premium y tienes el interés. So si tiene interés, tiene cash value. Okay. A little bit more. Okay, we just saw that one. Which of the following determines the cash value of a variable life policy? Let's see, the premium mode, the performance of the policy portfolio, the company's general account, or the policy's guarantees.
I'm gonna say B, but I think it's wrong. So I don't remember the.
So which of the following determines the cash value of a variable life policy? The performance of the policy portfolio. It doesn't depend on the premium. It doesn't depend on the general account, because we know variable accounts has two separate bank accounts, right? Like two separate accounts into one. So it's not C. And the policy's guarantees, I think you're actually right, Tatiana. Let's see. So variable depends on the policy portfolio. On that performance is the cash value. It's going to depend on that performance. Good job. Good job. Good job. Because I know those are confusing. Which of the following is a key distinction between variable whole life and variable universal life products? So variable universal life has a fixed premium. Variable whole life has a guaranteed death benefit. Variable universal life is regulated solely through FINRA. Variable whole life allows policy loans from the cash value. Anybody wants to try to tackle it? So which of the following is a key distinction between variable whole life and variable universal life products? So I think automatically we can take C out because we went through all those accounts and we know, and it has to be regulated by more than one of them because now you're getting into the marketplace and things like that. So it's more than one. So C can go out.
Let's say D maybe.
Variable whole life allows policy loans from the cash value. It does. Variable universal life. It also allows the cash withdrawals. Whole life, variable universal life, fixed. No, let's see. It's a flexible premium, so it's not A. It's not down. Would it be B then? Variable whole life has a guaranteed. B.
Good job.
Okay, so variable universal has a flexible premium. That's when we're eliminating this one. This is the first one that I eliminated because when we're going into that securities and separate accounts, you're regulated by more than FINRA.
Yeah.
It's more than that. Variable whole life allows policy loan from the cash value. Every single policy that has cash value allows you to take money out. So we did this solely by process of elimination. Solely by it. And so variable whole life has a guaranteed death benefit. So let's say this one. Get and guarantee returns. Okay. Let's see a little bit more down and see if I find another one. Okay. To sell variable life insurance policies, an agent must receive all of the following except which one? So to sell variable life insurance policies, an agent must receive all of the following except SEC registration, FINRA registration, security license, and a life insurance license. Which one we do not need?
See? Security.
Security license is the investment one. It's a series.
Oh, okay.
So we need that one, and we need the life insurance.
Yeah.
So I think it's A, because the agents need to be registered with FINRA. SEC, I don't think, actually, I know we don't register with them. They oversee the security exchange. Is it commission? Yeah. They oversee, but we don't need to register. So agents selling variable life must be registered with FINRA and have the 2 licenses. Okay. So SEC.
Yeah, right there, no agent.
Is for securities, not agents, correct. So SEC registration, when it means securities, it means those markets, like las acciones, las compañías que se ponen a vender sus acciones, those companies need to register with SEC. We as agents register with them. They regulate the stock market and things like that, but they regulate the products that we invest in, but we don't need to register with them. It's just the stock market. A little bit more down. Variable whole life insurance is based on what type of premium? Level fixed, increasing, flexible, or graded? So a variable whole life. What the heck did I just say? Oops.
Can be.
Ellis thinks it's flexible.
Me too, because I think the same.
Level fixed.
Oh.
So variable whole life insurance is a level fixed premium investment-based product.
You see, that was confused us when they start mixing this together.
Okay, so the question said variable whole life, it's a fixed. The premiums are fixed. If it's a variable universal, then it's a flexible. Okay, so variable whole life insurance is based on what type of premium? So now it's level fixed. We got the same question, but it's level fixed. I'm glad we got the same one. Made us think. A little bit more down. An insured purchased a life insurance policy. The agent told him that depending upon the company's investments and expenses factors, the cash values could change from those shown in the policy at the issue time. The policy is an annual renewable term, an adjustable life, an interest-sensitive whole life, or a credit life. So it depends on the investments and the expenses of the company. So the cash value can change depending on those. What do you guys think? Oh, see, that has a weird. Yeah, it can't be that one. I think it's this one.
So told him that depending On the company investments and expense, cash values will change from those who shown in the policy at issue time. This is a
Yeah,
Hmm.
so
I don't know this one.
I'm gonna go with C. So another option is if you don't know, see your way out. No. I think it's interest sensitive because it's making it sound like it's gonna depend upon the company's investments, which is like the interest and how it's doing. I'm gonna see
Okay.
if that logic works. Anything. Okay. So it says because the cash values are generated by investments, interest rates will affect the amount of the cash value. So in this scenario, sometimes we try to complicate ourselves, and I'm super guilty of that. The question is telling me it's sensitive to how it's doing out there. So the one that is most sensitive in the options will be the interest sensitive life. To be honest with you, in what we have covered, I never seen a credit life option. I don't know if you guys remember reading that. Annual renewable term, there were a lot of questions about that one already. In adjustable life, we know it goes on the same, basically, general accounts. So the cash value will not be depending on the interest of it. We have a guaranteed interest on what it's called an adjustable life. Okay, so we haven't seen this part over here. You want to keep doing questions, so you want us to go over the chapter a little bit.
One more question.
Questions? Yes, okay. So this part over here is a combination of plans though. So it'll be like that joint life, survivor life.
Oh, we got that. Okay.
Yeah, we haven't done this part. So joint life is a single policy that's designed to insure 2 or more lives. The premium is based on a joint average age. So if it's me and Al, so I'm only 35, he's like 48. It'll be on the average one. Yeah, I thought he was gonna like.
You watch your mouth.
There you go.
I was waiting for him to say something.
So it will be.
I'm 28 and a half. Thank you very much.
Yeah, right. So it's based on the average of both ages, and then the death benefit is paid when the first one passes away. So when the first death only. So if we have policy for both of us, one of us dies first, then that person receives, whoever is survivor, but it's kind of like weird because of the other policy says survivorship life, so it confuses me. But the joint life, whoever lives gets the policy after the first one dies. Okay, so premium is, we always and have been saying, based on attained age. On this case is the average of both.
So they basically get the middle age between y'all?
The middle age between, I'm sorry, you were saying?
No. Basically, the other spouse will become the beneficiary.
Correct. So let's say it's me and Al, I pass away, he's the beneficiary of the policies, he automatically gets the amount, the money. So it's going to find, let me just try. So this type of policies are usually used like if we're not gonna need, like they don't need protection extended the death of one of us. So if there is no longer any protection needed after one of us passes away, because that technically covers what would have been needed, then it gets this. So it says, for example, a married couple purchasing a house may use a joint life policy for mortgage protection if both spouses work and earn close to the same amount of income. If one spouse dies, the insurance pays the mortgage for the surviving spouse. It's also used to insure the lives of business partners in buy-sell agreements. So like if one partner dies, then the other partner kind of gets the benefit to buy that family out. So things to know: premium rates on a joint life policy are determined by averaging the ages of both insureds. Okay, so like I said, I'm 35, he's 48. The average, that's how they calculate the premium. Okay. So survivorship life. When you think of joint life, when you think of joint life, just think of first to die. When the first two die, when the first one dies, that's when that policy pays. Survivorship life pays when both of them pass away. So after the second one dies, that's when the policy pays. It's also referred as second to die or last survivor policy. It's much the same as the joint life in that, you know, it's the average of both ages. The major difference is that survivorship life pays on the last death. So if we have a survivorship policy, I pass away, it will not pay until Al passes away, and then our kids will get the money. Or whoever the beneficiary will be. But joint life, after the first one dies, the other one gets the money. Okay, so things to know: joint life, first to die; survivorship life, second to die. So last survivor. Then we go into the annuities. So annuities, principles and concepts. An annuity is a contract that provides income for a specified period of years or for life. An annuity protects individual against outliving their money. So means you have a lot of money out there. An annuity basically kind of does an average of how much you can be getting per month, or kind of you choose that calculation and start pulling. So when you pass away, you don't have like accounts with a lot of money in there. What do you mean?
It says it's the income, right?
So yeah, to get it. Oh, you're not correct. So do you have parties to an annuity, which is the owner, which is the purchaser of the annuity contract, similar to the part of the life insurance or the parties of a life insurance. So you have the owner. The owner of the annuity has all the rights, such as naming the beneficiary, surrendering the annuity. The owner of the annuity may also be a corporation, a trust, or another legal entity. An annuitant is the person who receives the benefits or payments from the annuity, whose life expectancy is taken into consideration and for whom the annuity is written. So know this, because annuities are based on the life expectancy of an annuitant. The annuitant must be a natural person regardless of who owns the policy. So the owner of the policy can be a corporation, can be a trust, can be a legal entity, like a paper basically, right? But because the annuities are based on the age of a person and the life expectancy of that person, the annuitant can only be a natural person, right? So it cannot, the corporation can be the owner, but it can never be the annuitant. The annuitant has to be the person. The beneficiary, just like the life insurance policy, is the person who receives the annuity assets, either the amount paid into the annuity or the cash value, whichever is greater. If the annuitant dies during the accumulation period, or to whom the balance of the annuity benefit is paid out. So the owner pays into annuity, who pays into the annuitant, right? So the corporation can be paying into an annuity, and then the annuity pays into the annuitant, who is the person in which, you know, it's calculated based on the life expectancy. So now you have the accumulation period versus the annuity period. The accumulation period is also known as the paid-in period. If you've seen Miguel's videos, that's when he does the triangle. And then this is accumulation period, which you're paying into the annuity. You're paid over time, which the owner makes payments of the premiums into the annuity. Furthermore, it is a period of time during which the payments earn interest on a tax-deferred basis. The annuity period is also known as the annuitization period, liquidation period, or payout period. Is a time during which the sum that has been accumulated during the accumulation period is converted into a stream of income payments to the annuitant. So that's when you think of the triangle or the curve, basically, when you're going up, that's the accumulation period. When you're going up the hill, you're saving and paying and paying and paying and paying and letting that cash accumulate. And then you have the annuitization period or liquidation period or payout period. and that's when you start receiving that money. Okay, that's the part. So the new annuitization date is the time when the annuity benefit payouts begin, or it's, you know, the trigger for benefits. I'm gonna play this little video real quick. Explains it better.
A simple way to look at how an annuity works is to think of a bag of money that an investor accumulates over a period to use as a financial nest egg. When the accumulation period begins, the investor opens the bag and places an initial sum of money inside, and, in the case of a deferred annuity, starts making periodic deposits into the bag when he has a financial opportunity. During the accumulation period, the investor retains ownership of the bag. The investor's name is on the bag, and he or she is able to direct the insurance company with regards to how the money inside the bag should be invested to achieve the desired rate of return. During this period, the investor can also withdraw money from the bag, either through loan provisions or partial withdrawals. When the investor decides to annuitize the contract, many things change with respect to the bag of money. The bag is sealed so that no additional investments can be placed in it ever again. In the annuitization of the contract, the investor gives up ownership of the bag, and his name gets replaced with the insurer's name. The insurer then begins making payments to the investor based on the payment schedule that the investor chooses. Depending on what type of payout the investor chose, the insurer may not even return the entire principal sum invested throughout the accumulation period. As is the case of a life-only settlement option, where the investor is paid a specified amount for life. If the investor dies too soon after annuitization, the insurer will keep what is left in the bag. Generally, investors should design an annuity plan that provides them with many investment options, low fees and expenses, does not force them to annuitize the contract, and provides reasonable withdrawals to be made throughout the accumulation period.
Did that explain that a bit better? All the options there is now. Did it confuse you more? You're muted.
Sorry, I had the baby here, so he was talking.
Okay.
No, I think how you were saying it was better than what I just seen.
Oh, okay, yeah, at least it's the same. So
Right?
when you're going up, it's that bag open, you're paying. When you choose to annuitize, you can no longer withdraw from the money, because basically you're telling the company, I have X amount of dollars and I want X amount paid during X amount of time. So you can no longer put or withdraw from it, because now they're paying you. So the accumulation period, you're paying in, and then the payout period, they're paying you. You can only put money in when you're accumulating.
Okay.
After that, you cannot touch that money. They're paying you based on what you desired, but you can touch it. So we saw this owner, when you pay into it, that's accumulation. And then when it's paying out, it's the annuitization or payout period. So annuity income amount is based upon the following: the amount of premium paid or cash value accumulated, the frequency of the payment, interest rate, and the annuitant's age and gender. The shorter life expectancy equals higher benefit. Longer life expectancy equals lower benefit. All of that basically says what I just mentioned. Annuities are purchased for the most part as retirement accounts. So people use that accumulation period or paying period while you're working. And then once you retire or want to cash out, live off that money, that's when they start the cash out period. So types of annuities, you have single premium or periodic premium. Just like when you were thinking about life insurance and we said single premium, you paid everything in one payment in it to accumulate. So if you do a single premium, you're always going to accumulate faster because everything is in there. Then you have periodic payments, in which the premiums are paid in installments, right? So immediate versus deferred annuities. Annuity, the payments begin within 1 year, and the deferred payments begin after 1 year. So if you're think about these graphs, how we have the graph up here, right? Owner, and then you're paying into your annuity, and then you payout. So when you're paying into the annuity, you can pay it in two forms, in one full payment, or you can pay in installments. If you pay one full payment today, you can decide to start the annuitation, the payout period within a year, because you already paid the whole amount that you wanted in it, right?
Okay.
So within a year, you can start cashing out. Now, if you're doing periodic premium payments, then you have to wait more in order to start cashing out. Does that make sense?
Yes.
Okay. Notice an immediate annuity is purchased with a single premium. Income payments from a deferred annuity begin sometime after 1 year from the date of purchase. So what I just said a little while ago. Then we have fixed annuities. So a fixed annuity provides the following features. Yeah. Thank you. I appreciate it. So guarantee minimum rate of interest to be credited to the purchase payments, income payments that do not vary from one payment to the next. Just think fixed annuity, it's fixed, it does not change. So it's a guaranteed minimum rate. The insurance company guarantees the specified dollar amount of each payment and the length of the period of payments as determined by the settlement option chosen by the annuitant. So it's my account. Have you seen those commercials? It's my money and I need it now. So they're talking about like basic. There you go. So they're talking about a annuity, right? So, but you choose how you want your payment. It's your account. You're telling that company, hey, I need you to pay me, and this is how I want to be paid on the fixed one. Now, if we're talking about variable, let's go straight into this, the graph over here. So we have the fixed and the variable. The interest rate for a fixed is guaranteed. A variable is non-guaranteed. Just like when we saw the life insurance, if it's variable, then it's like not guaranteed in it, right? Underlying investment, the fixed annuity is general accounts. It's safe, it's conservative. Just like when we were talking about the cash value of the life insurance, the general account, you always have a guaranteed, a percentage that is paying to you. You don't lose the money. The variable annuity, they're separate accounts, they're equities, so it's not a guaranteed. Unfortunately, if the market crashes, that crashes with it, okay? License needed for the fixed annuity, only the life, like we were talking about the life insurances as well. For the variable, because you're talking about securities and investments, then you need your life insurance plus your securities license. So security is just another name for the investments. Expenses, they're guaranteed on both. All of the accounts are going to have expenses in it. Income payments are guaranteed on the fixed accounts, but if you have a variable, it's not guaranteed that you're going to receive income from it. It all depends on how it does. So the good thing about this one, even though annuity, just think of it as a retirement account. You pay into it, and then you decide how you want your money out. Now you have two types of annuities. You have your fixed and you have your variable annuities. If you remember what we went through the life insurance, those cash values, certain type of life insurance has your fixed and has your variable, right? So the fixed is the general account. You always get a rate of return. You're not losing your money. You may not make as much, but you're not losing money. Your variable, you get money back depending how it does on the market, right? Depending if you lose money, that's why there's separate accounts. But if you lose it, you're going to lose it, okay? So index annuities or equity indexes are fixed annuities that invest on a relatively aggressive basis to aim for higher returns. So you're still under the fixed annuity, but now you're an index. So you're more aggressive. So you might be investing accounts that might give you a 9, a 12% return. And it has a guaranteed minimum interest of 3 or 4%. So you still get some money, even if you don't do as good. Let's say your investments only did 2%, they're still going to pay you 3 or 4, right? Depending on what it says on the contract when you get it. But you're invested into those higher accounts. Let's see, I don't want to play that because that's going to confuse you a little bit more. I'll take this picture for me and then I'll see if an easier way to explain it. When I say for me, I always send it to my dear husband, and his chat is basically the one that I say for everything. Okay. So payout options, the annuity payment options specify how annuity funds are to be paid out. Like we discussed, on the payout period, you can tell the company how you want to be paid out, how often, how much you want, and things like that. Pure life annuity provides the highest monthly benefit, but there is no guarantee that the entire principal will be paid out. So like the graph was saying, if you happen to die too soon, something happens to you, the annuitant, like that investor or a new company, they will keep that money, right? So what is important to remember, in the annuity, you have survivor's benefit only if you choose them and only if they offer them. So I've heard enough people saying, hey, I died and I lost all the money that was in that account, and it's because it didn't have any survivor's benefit in it. So let's say I have an annuity and I say, hey, I want survivor's benefit. I go to whatever, and that's not in here, but it's something for us to keep in our heads. If you have the option of not losing the money. So if you're talking to people, maybe your mom, your dad, your uncle, that they have annuities, just make sure that they have survivor's benefit in there so their spouse can keep getting that money even if something happens to them. So we said pure life annuities, it provides the highest monthly benefit, but there is no guarantee that the entire principal will be paid out. So that means, like I said, if they die too soon, you have two types of refund life annuities. The cash refund is when the annuitant dies. The beneficiary receives a lump sum refund of the principal minus benefit payments already made to the annuitant. So that's every cash they put in minus any cash they received. At least they will get that. They wouldn't get any interest earned, but they will get the money put in. Installment refund, when the annuitant dies, the beneficiary will continue to receive guaranteed installments until the entire principal amount has been paid out. So they have to choose those. However, any unpaid annuity benefits following the death of an annuitant are taxable when paid to the beneficiary. So as opposed to the life insurance, so we saw life insurance is non-taxable to the beneficiary, the annuity is. So annuity is non-taxable for me because I'm paying it, if I'm the one receiving it, in my accumulation period, I paid it out of already taxed money. So I'm getting it tax-free. Now, if Ellie is my beneficiary, something happens to me, now she didn't pay taxes on that money. And now it's income to her, so now she has to pay taxes on the money she's receiving. Okay? Because you know Uncle Sam always wants his share.
He does.
So I don't want to kind of confuse you more. Let's see. Okay, we're almost there. So we have single life versus multiple life. Single life annuities covers one life, and annuity payments are made with reference to one life only. Multiple life annuities cover two or more lives. The most common multiple life annuities are joint life or joint and survivor, like we just saw. So joint life is a payout arrangement where two or more annuitants receive payments until the first death among the annuitants, and then payments stop. So joint life, like we saw on the life insurance, joint life, and in life insurance, when one dies, the other one gets the benefit. The annuity, they're both getting payments, but once one dies, the payment stops. Now, joint and survivor arrangements is a modification of the life income option, and it guarantees an income for two recipients that neither can outlive. So the beautiful thing about this one is that the way they're calculated, you can outlive your money. So annuities, certain types, we have fixed period. This is when you tell them, hey, I feel weird when I don't have them. When I don't see anybody, I feel like I'm talking to myself. I minimize the cameras and I'm like, wait, I can't touch the screen. That's weird. So fixed period is fixed period installment. So es el periodo del tiempo, but it's fixed. So you're telling them how many periods and how many payments you want them, okay? So you determine how much each payment will be based on the value of the account and the future earnings projections. Future earnings projections means if the market is an average of 3-4%, how much more money I'm going to get. It's a projection of the cash that you're going to have on the accounts, and then you decide how much money you want to get per month. Fixed amount, you decide how much each payment will be. In fixed period installments, you decide how many payments you want. So you want in 5 years, in 10 years, you know, like how many payments you want from there. And then the fixed amount installments, then it's the amount, just like it's saying, it's the amount that you want. I'm going to skip those videos because they're tending to kind of, yeah. And then this is all the reviews of them. So let's go ahead and just do like a question or two from the practice questions, and then we jump into the quiz, and then we call it a night. Does that sound good?
Okay.
Yeah, okay, perfect. And then, yeah, because we need coffee over here to keep going. All right, perfect. Let's go. Which of the following is another term for the accumulation period of an annuity? Is it the liquidation, the annuity, the pay-in, or the premium period?
Premium?
Ellie says pay-in, Tatiana says premium. Anybody else? No, so we're talking about the curve, basically.
So
Accumulation,
period.
we're paying into that account. So the accumulation period is also known as pay-in. It is a period over which the annuitant makes payments into. So your premium period, there is not really a premium period. Premiums is what you're paying in. So they're just putting that in to confuse us, because we're thinking premiums is when I'm paying. So your logic was right. Like I'm paying premiums, but it's not an option either. They're just throwing it to like, to throw you off. Exactly. Yeah, confuse you. So pay-in period, payout period is kind of like the easiest way to remember it. Let's go. Was that the beginning of it? Let me see. Okay. The president of a company is starting an annuity and decides that his corporation will be the annuitant. Which of the following statements is true? A corporation can be an annuitant as long as it is also the owner. A corporation can be an annuitant as long as the beneficiary is a natural person. The contract can be issued without an annuitant. D, an annuitant must be a natural person.
D.
D. So the annuitant is the one that we're calculating the life expectancy from in order to get these numbers and calculations. So it must be a natural person. The corporation can be the owner of it, that's for sure, but it cannot be the annuitant. The premium of a survivorship life policy compared with that of a joint life policy would be higher, as high, half the amount, or lower.
The premium was.
So I think they're just trying to confuse you. When it's terms of what Ellie says as high, so when in terms of survivorship and joint life, the only difference in those policies is how they pay out. But they're both calculated based on the average amount, based on the average everything of both. So we're gonna go with as high, and it's actually lower. So survivorship life is much the same as joint life in that it insures 2 or more lives for a premium that is based on a joint age. The major difference is that survivorship life pays on the last death rather than upon the first death. Since the death benefits not paid until the last death, the joint life expectancy is in a sense is extended, resulting in a lower premium than that which is typically charged for joint life. Did you guys get it? Because I just, okay. So the terms of calculating the policy is the same. So my head went straight into my monthly payments will be the same.
Okay.
But the survivorship pays at the end. And then the premium for survivorship life policy, and then the joint life pays on the first one. So because it pays out on the first death, the company says, hey, you're gonna pay me for less years or less months. So it's gonna be higher. The survivorship, it's gonna pay the second death, right? So the company knows you're gonna pay for more, so therefore the premiums will be lower. Now think about it as the company, as if you're giving them the policy, I'm gonna pay this policy once the first one leaves. Chances are, one is gonna die sooner than the other.
Yeah.
Yep, it's a higher risk. The other one I'm gonna pay when the second one dies, so I'm gonna be getting paid for more time. So it'll be a lower compared to the other one. Okay, so a little bit more down. In a survivorship life policy, when does the insurer pay the death benefit? Survivorship life policy, upon the first death, half at first and half at the second, if the insurer survives to age 100, or upon the last death.
Upon the last death.
Yes. Okay, perfect, upon the last death. Okay, which of the following is not a term for the period of time during which the annuitant or the beneficiary receives income? Depreciation period, annuitization period, payout period, or liquidation period. So think again on that triangle, right? You're going in, you're paying in. It's not a term for a period of time during which the annuitant or the beneficiary receives income. So when you're receiving the income, you're paying out, you're liquidating, and when you're paying in, depreciation, it's not even, I think that got me last time. It's not even a term. It's of the period of which the annuitant or the beneficiary receives income. So if we go, no, those are different. I think it's a notice. Ellie's right. You see, I'm trying to confuse her, and she's like, "No, ma'am, no, ma'am." So when I don't know if you saw that I changed the background. I mean, not the background, like I scrolled. So your accumulation period when you're paying in, your annuitization period is when you're paying out. So it's your annuitization period, you're paying out, or you're liquidating the account. So the only one that does not belong will be your depreciation. Annuity, liquidation, or payout. Perfect. You see, why are you interested in taking the test? So the president of a company, okay, we already went through this one. A little bit more down. Which of the following is true regarding the accumulation period of an annuity? It is a period during which the payments into the annuity grow tax deferred. It is also referred to as the annuity period. It is a period of time during which the beneficiary receives income, or it is limited to 10 years. So you're looking for the true answer, means there's one right answer. And it's regarding the accumulation period of an annuity. So is that a period which the payments into annuity grow tax deferred? It is also referred to as the annuity period. It is a period of time during which the beneficiary receives income, or is it limited to 10 years?
B
Or
A.
Ellie was asking me, what does it mean to be tax deferred? So it means you're growing tax deferred, that you're going to pay taxes on the growth of it once you start getting the money out. It is refers to the annuity period. I think it's A, but I'm gonna put B because you guys say B. You guys say B? Yes.
Yes.
Okay.
I'm between those two, the A or B.
Yes. So it says, which one of the following is true regarding the accumulation period of an annuity? So accumulation period like read this way, it's a period during which the payments into the annuity grow tax deferred. It is also referred to as an annuity period. I honestly think there is no annuity period. Like, I'm trying to go back to the graph. So you have your accumulation period, and then you have your annuitization period.
Okay.
Okay.
So we didn't read any limits to the years. Accumulation period is not when you're receiving the money.
Mm-mm.
It is when you're growing your money tax deferred.
Okay.
So it confuses you because it's putting tax deferred and you know you're not seeing any taxes or paying any taxes until you get your money out. But the moment you're putting money in, that all that money is growing tax deferred, meaning the taxes will be paid later.
Okay.
Okay, let's do a couple more and then we go into that quiz. That president of the company, he needs to get his class together. Okay. An individual has been making periodic premium payments on an annuity. The annuity income payments are scheduled to begin after 1 year since the annuity was purchased. What type of annuity is it? And so it's telling you
It-
the annuity income payments are scheduled to begin after 1 year. And it's telling you also that it's good catch because it's periodic premium payments. It wasn't a single one. So automatically it cannot be an immediate.
So periodically. So
Mm.
that's be flexible.
B says
Oh.
deferred, it's when you get your money immediate or deferred. So deferred just means later. So you
Okay.
either can get your money now, because I know it gets confusing because it's usually used after tax. So when you see defer, you're thinking taxes, but defer just means later. Like diferido, algo después. I also think it's deferred because it's not saying anything about fixed or flexible payments. It's saying you have periodic premium payments on an annuity and you're scheduled to begin after 1 year since the annuity was purchased. So if you see, I moved to the graph back here. If your
Okay. Yeah.
payments begin within 1 year, it's an immediate. If it begins after 1 year, it's a deferred.
Gotcha.
Okay, that's why I love this ones because you can play around with the back. Let's see, another practice. The main difference between immediate and deferred annuities is when the income begins, how the annuity is purchased, the number of insureds, or the amount of each payments.
How it's purchased.
Those are very good options. I do think it's how it's purchased. The main difference between immediate and deferred annuities is it's when the income begins. At Elios, right? And that throws you off because I could have sworn it was when it was purchased because
Yeah,
you can
because
purchase
depends
it.
how. Yeah, because how they're gonna know which one they chose.
So you can, I guess, because you can always purchase it in one payment, but you have the option to do the immediate or deferred.
Yeah. So
The
how would
difference
they know?
between immediate and deferred annuities is because over here you see like it's telling you the difference is payments begin within 1 year or payments begin after the 1 year. So the main difference between immediate and deferred annuities is when the income payments begin. Immediate annuities will begin within the first year, while deferred annuities will not begin payments until sometime after the first year. Those little ratitas. Who bears all of the investment risk in a fixed annuity? The owner, the beneficiary, the annuitant, or the insurance company? So when we're thinking about risk, we're thinking about that investment part of the accounts, or like the insurance parts, but we're talking about variable annuities, so the investment parts. So when thinking about in a fixed annuity, so we spoke about fixed and how it's guaranteed, right? Has certain type of guarantees in it.
Is it
And
the
then-
insurance company?
It's the insurance company, yes. when we talk about variable, then the owner will be the ones that bears all the investment risk. So fixed annuities guarantee a minimum amount of interest to be credited to the purchase payment. Income payments do not vary from one payment to the next. The insurance company can afford to make guarantees because the money of a fixed annuity is placed in the general account of the insurance company, which is part of its investment portfolio. The company makes conservative enough investments to ensure a guarantee rate to the annuity owners. So perfect, Tatiana, the insurance company. So a little bit more. What license or licenses are required to sell variable annuities? Both a life license and a security license, only a life insurance, only a security license, or no license is required. Ellie says both.
I guess both, since we're selling different things.
Yes, perfect, both. And that question I did see, and I saw written like 2 or 3 times in different ways, because they want to make sure you know you're required to have a license to sell certain products and which license is for what product. So we're on the payout options. Let's see. Which of the following is not true regarding a life with guaranteed minimum annuity settlement option? That was a mouthful. The beneficiary receives the remainder of the principal amount upon the annuitant's death. Payments can be made in installments and as a single cash refund. It does not guarantee that the entire principal amounts will be paid out. It is a life contingency option. So this is regarding joint life. Which of the following is not true? So we're looking for the wrong answer. So there's a few right answers in here. So the beneficiary receives the remainder of the principal amount upon the annuitant's death. Payments can be made in installments and as a single cash refund. It does not guarantee that the entire principal amount will be paid out. And it is a life contingency option. Which one do you guys think?
See?
I think C and let's see my count.
It's not true.
Correct. It's not, so we're looking for the wrong answer. Just so cash refund installment.
The
It's
payments
life contingency, but I'm not
Yeah,
sure.
I'm looking at that one too.
Because I can honestly say I don't remember or know the answer to this one.
okay.
So I do, from what I remember, I kind of read in the background, the beneficiary received the remainder of the principal amount upon the annuitant's death. Life with guaranteed minimum annuity settlement option. So he has a guaranteed minimum. So I know B and C are out. Payments can be made in installment as a single cash refund. It does not guarantee that the entire principal amount will pay it out. I think it's D, but I'm not 100% sure. So you guys want me to try D, or guys want me to try something else?
Try D.
Okay, let's try D. It's C. It does not guarantee the entire principal amount. Tatiana was right. See? You said that one, right?
Yeah.
It does not, because we saw it even in the videos that it doesn't guarantee. So even if it's a joint life, it still does not guarantee that the principal amount will be paid out. If the annuitant dies before the principal amount, the amount paid for the annuity has been paid out, the remainder of the principal amount will be refunded to his or her beneficiary. Pure Life provides the highest monthly benefits for an individual annuitant, but it will still not guarantee that the entire amount will be paid out. A little bit more down. Which of the following is not true regarding an annuity certain? Certain? Okay. There are no life contingencies. It is a short-term annuity. Benefits stop at annuitant's death. It will pay until a fixed amount is liquidated. So which of the following is not true? You're looking for one wrong answer. which is not trigger annuity certain. Mhm.
Hmm.
Sure, I'm trying to see if I can fix them out. Okay, that's fixed. Which of the following is not true regarding an annuity certain? Fix them on installment, the annuitant selects how much each payment will be. Whether or not the two benefits. So this one, see, it says this option pays a specific amount until funds are exhausted, whether or not the annuitant is living.
See.
So it'll be C. Okay. The beautiful thing about you guys doing these practice questions is that you can scroll and see if you can find the answer. It's like doing homework. You guys, I don't know if you guys remember doing homework back in, since I just graduated high school like 5 years ago. I remember doing homework. Those girls live around. Okay, let's do one more. This is the whole summary of everything. Let's do a practice question. Which of the following is a short-term annuity that limits the amount paid to a specific fixed period or until a specific fixed amount is liquidated? Which of the following is a
Fixed.
short-term to a specific fixed period until a specific fixed amount is liquidated? It can go. Annuities. It's the same question we just saw backwards.
Yeah.
How do in the get you, which of the following is a short-term annuity that limits the amount paid to a specific fixed period or until a specific fixed amount is liquidated? So an annuity certain option allows the annuitant to select the time period or the amount of the benefits to be paid out under the installments for a fixed period. Distribution begins on a specific date and stops on a specific date. So I guess that's why they call it certain. So it's como que te aseguran, that word certain, te aseguran que te van a pagar during a certain amount of time, there's a certain amount of period, and like certain amount of payments and certain amount of money. So you're guaranteed that those fixed amounts. Okay, so let's try a quiz and let's see how we do. We're gonna do great. I know we're gonna do great. Okay, types of life insurance policy. Which of the following would help prevent a universal life policy from lapsing? A, corridor insurance. B, target premium. C, face amount. D, adjustable premium. They went in with a
Target premium.
I'm sorry?
Target premium.
I do think you're right. It's talking about universal life. So you have a minimum and a target. So the target, so let's go. Do we agree with going with target? Not going to target, but going with target. Yes? Okay. Perfect, Tatiana. Look at you. Let's go to next question. Fixed annuities provide all of the following except minimum guarantee rate of interest, future income payments, hedged against inflation, equal monthly payments for life. So we can do either process of elimination, right? So we just saw the annuity certain on the last question that we saw on the actual chapter, right? And it had all these fixed amounts because you have the amount guarantees for a certain period, a certain amount, they're equal monthly payments. So for me, if I go kind of like getting options out, I will say is which one?
Well, we can take out the minimum guarantee rate of interest because it's a fixed one.
Yeah, so fixed one, you have a guarantee rate interest. So the variable, so we can take that one out. That one is right. So that's
And we're taking the monthly payments out.
And we're taking the monthly payments out. That one is right.
Mhm.
So if you're thinking about future income payments, you're deciding for how long they're gonna take you. So technically you get future.
So
So
see,
Is it right? Yes, it's right.
Yeah.
You see me, I'm closing my eyes and everything. So fixed annuities invest premium payments into a journal account, safe and conservative investment portfolio. They also provide specified dollar amounts, so like everything we saw, but they don't, and therefore providing protection against inflation. So hopefully maintaining a constant purchasing power, meaning like power to keep buying stuff to protect you against it. So next question. Which of the following best describes what the annuity period is? The period of time from the accumulation period to the annuitization period, the period of time during which money is accumulated in an annuity, the period of time from the effective date of the contract to the date of its termination, the period of time during which accumulated money is converted into income payments. So think about the graph, right? We had money going in, that's the annuitization period. Money goes into the annuity, and then from annuity, it goes into the payout period, which is the income. So the annuity period, it's, Ellie thinks is A. Do you guys want to go with A?
yes.
Yes, that's what I thought when I thought at the time, and it was D, and it's exactly the same thing. So the period of time during which accumulated money
Isn't it income and annunciation the same thing?
Yeah. That's how it was.
Yep. That's how I went with A too, because the graph shows you that. So let's see what's the difference. So one says from the accumulation period to the annuitization period. The only one is telling you that the annuity period is the time during the accumulated money is converted into the income payments.
Oh, that's gonna be so confusing.
So it's not from and to, is that during that time, the annuity period is a period in which it's converting itself.
Oh, because it's during and not from.
It's during and not from. So that's the only difference in that one. And that one got me too. I was like, but those say the same thing.
Yeah.
Okay, let's go. We still got the concept, which is great. An individual has just borrowed 10,000 from his bank on a 5-year installment loan requiring monthly payment. What type of life insurance policy would be best suited to this situation? A decreasing, a variable, a universal, or a whole life?
Hold on. You got me.
So you just borrowed $10,000 from the bank on a 5-year installment loan, which means you're going to pay it down to 0 in 5 years. So
Increasing term?
decreasing. Yep, decreasing term. So it's the only policy in which the face amount starts going to 0. So the first year may be 10, then 8, 7, all the way down to 0. The insured is also the policy owner of a whole life policy. What age must the insured attain in order to receive the policy's face amount? 100. Ellie says 100.
Sí.
Sí. Con un bastoncito ahí o una wheelchair and be like, give me my money.
Oh, God.
Okay, next question. Which two terms are associated directly with the way an annuity is funded? So increasing or decreasing, immediate or deferred, renewable or convertible. She didn't know that it was a touch screen.
I said, we didn't finish reading.
Yeah, her finger just went through and we're like, click. I was like, you're right. Okay. So we know increasing or decreasing is kind of level term. Immediate or deferred is how you want your money out. Renewable or convertible is how your insurance is. You can have them. Single payment or periodic payments is how you can fund your annuity.
Yes.
Yep. As Ellie very graciously showed us. So, right, twin brothers are starting a new business. They know it will take several years to build the business to the point that they can pay off the debt incurred in starting the business. What type of insurance will be the most affordable and still provide a death benefit should one of them die? Would be ordinary life, joint life, decreasing term, or whole life?
Join life?
So I think the giveaway on this one is you're talking about two people. So joint life, and that specifically joint life is used more for business partners. So very, very good. Question 8, the annuitant dies while the annuity is still in the accumulation stage. Which one of the following is true? So we're looking for that one right answer. The owner's estate will receive the money paid into the annuity. The insurance company will retain the cash value and pay back the premiums to the owner's estate. The money will continue to grow tax deferred until the liquidation period and then will be paid to the beneficiary, or the beneficiary will receive the greater of the money paid into the annuity or the cash value. Which one do you guys think? So think about it. You die during the accumulation period, the accumulation stage of your annuity. So the owner's estate will receive the money paid into the annuity. The insurance company will retain the cash value and pay back the premiums to the owner's estate. The money will continue to grow tax deferred until liquidation period, or the beneficiary will receive the greater of the money. Ellie thinks is B. Do you guys think
They will pay back the premiums.
the premiums? Let's see, we're right.
No.
Oh, the beneficiary will receive the greater of the money paid into the annuity or the cash value. That's even better, because I honestly, the part that we read, it said payback premiums. So now we know that when the annuitant dies in the accumulation period, so they haven't even decided when they're going to liquidate, how they're going to get the money out, and any of that, the beneficiary will receive the greater of the money paid into or the cash value that it has. So we'll pay one or the other. The least expensive first year premium is found in which of the following policies? Annually renewable term, increase in term, decrease in term, or level term? Which one do you guys think?
Level term?
So level term, the least expensive.
Oh, the
first,
least expensive?
yeah. So from the increasing, decreasing, and level term, I'll say it will be level. So Ellie thinks it's increasing. Tatiana, was it you that said level?
Mm-hmm.
And Patty, did you say something? Or it was somebody around you? I think it just highlighted. So which one do you guys want to go with? You say, Ellie says increasing and you say level. So let's say, I think it might be A, but let's see. It was A. So it's A because annual renewable term, you're letting them know every year you're going to renew, right? So you have that chance of renewal. So the first year it's going to be like less expensive. The face amount degrees. Okay. I'm just keeping track of the wrong ones. Which policy component decreases in decreasing term insurance?
Which component decreases in decreasing?
So it says decrease in term insurance. We automatically know there is no cash value in term. So A goes completely out. Decrease in term, we also know we pay the premium just the same. Right? So premiums are out.
Mm-hmm.
So think about decreasing as the mortgage or the car loan or that $10,000 that was the question a while ago. So our face amount decreases in term insurance. So think on the decrease in term, think of face amount as your loan amount. So every time you're paying your premium, your loan amount goes down, meaning your face amount of that loan goes down.
Okay.
Okay. So a return of premium term life policy is written as what type of term coverage? Increasing, decreasing, renewable, or level? So return of premium, I'm sorry?
No, I was reading when you were reading, I'm sorry.
Okay, no, it's okay. So return of premium term life policy is written as what type of term coverage? So we said return of premium is when we buy a term policy for a certain amount of years and we want the company to give us back the money paid in if we don't die within those years. So the policies tend to be more expensive, but they tend to be level, right? So we said, like if we buy a 20-year policy for a certain amount of benefit, they cost us about
renewable?
25 or I don't think it's increasing or decreasing. I don't think it's none of that.
Because when you renew, you're going up too. So I don't know, to be honest.
A return of premium term life. So we're term life. I think it's level. But it's just what I'm thinking. I'm not 100% sure. Do you guys want to try level? Want me to click renewable?
Level. Increasing. Look at that. Huh.
Because the life insurance is an increasing term insurance policy that pays an additional benefit to the beneficiary equal to the amount. Look at that. Okay. Yeah, no, I did, because I think that was one of the first ones that we saw. Your client wants both protection and savings from the insurance and is willing to pay premiums until retirement at age 65. What would be the right policy for this client? So they want, obviously they want the insurance and also want savings. So right there we know it's not C, correct. Now they just only want to pay until they're 65. They don't want to be paying any more than that.
Is it B?
I think we saw it as one of the review questions and it was limited pay whole life because it has, remember the LP 65? You limited pay until you're 65, but then you're covered throughout the whole thing. So let's go with limited pay whole life. Premium payments will cease at her age 65, but coverage will continue to her death or age 100.
We gotta do this after again.
Oh yeah. Which option for universal life allows the beneficiary to collect both the death benefit and the cash value upon the death of the insured?
Which option?
Life. Yeah, because corridor option.
Wait, option A is corridor and option B is fire. I mean,
See how they go.
A corridor. Oh my God. I don't know. I thought option A was corridor.
Option B, not the verbal, like the wording.
Right, so which option for universal? So, and this is how they get us. So the corridor option is included in option A and the variable is included in option B. It's a characteristic for those options. But universal life only has two options, A or B. Then inside option A, you have corridor, and inside option B, you have the variable.
Okay.
So my logic, again, I'm not saying it's 100% true, but the way my brain works is saying that it can only be A or B. It can't be both.
Yeah.
Right? And now, if we remember correctly, the death and cash value on option A were the ones that will pay both out, and that's why it was the most expensive option. Right? Do you guys remember that part? Like the graph, option A, it's like level and then it goes a little bit, but option B goes up at the same time. And then it
Yeah.
was saying something about paying it at the same time. So let's try option B and see how it goes. Yes, the death benefit includes the annual increase in cash values, so it gradually increases, and this is why this one is more expensive than the other one. Question 14, an insured buys a 5-year level premium term policy with a face amount of $10,000. The policy also contains renewability and convertible options. When the insured renews the policy in 5 years, what will happen to the premium? It will remain the same for new 5-year term. It will decrease for the new 5-year term since the insurer is now a lesser risk to the company. It will increase each year during the next 5 years as the face amount increases each year. It will increase because the insured will be 5 years older than when the policy was originally purchased.
D.
D. Yes. Okay, let's see. Which of the following best describes annually renewable term insurance? It is level term insurance. It requires proof of insurability at each renewal. C, neither the premium nor the face benefit is affected by the insurer's age. D, it provides an annually increase in death benefit. So which one is, so we're looking for the right answer, right? So we know annual renewable term. We know the premium is affected, so C is automatically out. We know the death benefit does not change. It remains this. So D is out. And I don't think you require proof of insurability at each year, right? So it is level term insurance. We go, I think we still failed it because we got 4 wrong, but, oh no, look at that.
Oh, look at that. We were thinking of her.
Yeah, I think the max wrong that you can get is 4, which we did. We got an 11 out of 15. Do you guys feel better from the chapter? I'm not gonna say like completely like I know it all because it's a lot of it information, but do you feel like you have a little bit more knowledge on this chapter now?
Yes, I have more knowledge, honestly. Like I was so confused on this chapter.
It was confusing, and it's good for me to kind of teach it like that because then I learn it more as well. So I'll say tomorrow we start. Are you guys gonna be here, right?
Yes, we're gonna be there tomorrow.
So we can take like an hour. And again, let me stop the share. I mean, stop the recording. Hold on. Let me stop share.